evening, friends, members. My name is Seng. Tonight I will share with you this question we sometimes trouble some of us. When you do day trading, should you close your position by the end of the day with the normal suggestion, or you can afford to try your luck and try to carry over? As usual, we would like to go through the disclaimer. So the information and material provided in the talk is for education purpose only. Nothing presented in the talk should be construed to be a recommendation to buy or sell any specific security. The information, software and techniques presented should only be used by investors who are aware of the risks inherent in trading. Singapore Microcomputer Society, SMS, and its executive committee have no liability for any investment decision based on the use of software, any trading strategy, or any information provided in connection with the talk. So the synopsis is day trading position. Should it be closed by end of day? Just a refresher for those who are not familiar what I mean by day trading. Okay. In general, most of us so-called buy a share or equity. The normal cycle in Singapore context, D plus 2 or D plus 3, you pay up for the share and then you wait for the price to move in your favor, then you have the profit, then you sell. That means you go through the trading cycle. But now, because of the invention of this called internet and all this, so there are people, especially in the US, it's pretty popular for people to do what I call to trade in microseconds or very short time frame. So effectively, within one day or within 1 hour, they may trade more than once. And the so-called the product or the item can be a stock, can be future, and or can be indices. So this it has become pretty popular or widespread because of the speed of internet. Right. But is this game for you or for me or for anybody? Then you have to ask yourself, are you belong to that kind of category where you have the fastest finger, you move very fast and you have the necessary tools. Example, you have subscribe to those platforms where they have give you the data. Normally they use software to help them in terms of look at the charts. So the chart can give you in terms of seconds or minutes of the performance of the share or of the stock or the indices. So if you didn't subscribe for this type of software or this type of chart, then you are not in a position to do day trading. Day trading effectively means you buy and sell within the same day. Whether you make money or lose money, you will close the position. I mean, you buy, if you hit your target, you sell, or if you drop below your anticipated target, you will sell. So effectively, within a day, you may trade many times, or you may select to trade 1 time or 2 times, depending what type of strategy or plan you have. That is called day trading. That's why the term day trading. So day trading doesn't mean everybody is able to handle it. You need to check your heartbeat, because sometimes you become very kanchiong, the price move very kanchiong, then you don't know how to manage it. Normally day trading, you should subscribe to those platforms or those software or those brokers that give you those so-called ability to do your setting. You can set stop loss, and that means you buy this point, drop below how much, you will cut your position automatically set in the system. Then if you rise above a certain point, you will set in the software, you will take your profit. That means should the price suddenly run up there, your position will be out. That means you already get out of the position, you take a profit. So the tools must be available, and the software that you, or the trading company or platform that you use must provide all this facility. Then you can do day trading. So not everything can be day trading. And there are some companies in Singapore also, you can subscribe to them and join the trading platform, and you put some money up there, then you're allowed to do trading. And they have also what I call stimulated, or they call it exercises for you to dry run, they play paper. That means like paper trade like that, whereby you think that the price go there, you set and all this. So they have what I call, they give you monopoly money, so you can play a bit with your monopoly money, whereby you don't actually lose or gain any money. That means virtual money. So if you, after practicing that, you think you are good, then you go sign on and then play with the real money.
This day trading, you are referring to which market? Singapore market or US market?
Can be Singapore market, can be Malaysian market, can be US market for day trading. But the trend started in the US market because a lot of people thought it's quite, those days, earlier days, they thought quite good or quite profitable. I mean, some of them, they can make some money from the market. But as more and more players come in, then you need to have more and more faster computer, faster tools and faster software, and then your software must react properly. Because some of the trading platform, they give you a software, they call it a sleep stage. That means you see the price, your software is up, but you want to hit it, you cannot hit it because they have certain delay time, all these things. You don't have the instantaneous matching. So sometimes you lose out on that.
Is Singapore a lot of day trading?
Sorry?
Singapore, Malaysia, a lot of day trading?
Okay. Singapore, technically, you can do day trading, but you have to check with the broking house that provide you the software, whether they allow you to do certain settings. But if they don't allow you to do those settings, then you are at mercy. That means you are the machine that actually do the sell, buy, and then after that you do the sell, you are clicking at that point. It means it's not automatic reset in the system. Then you lose out because you don't have the reset. Then you react time will be slow. Like, especially if you are trading those what I call fast moving product, then you lose out. Normally you need to have a certain software that the trading platform, the company provide you, then you can do. So, but this is quite common in most of the broking house or those software company that the US market one, they provide you. They are quite in Singapore, LG, Saxo, and all these things they provide you. You can sign up for dry out and all these things. Okay, so that is what I call day trading. So situation analysis. So what we mean is that, imagine you are already a day trader or you are going to be a trader. You normally buy and sell the stock or the currency or the future. These are all the different type of elements that you can consider. So throughout the trading session, typically all your trades are closed before the end of the trade. But now you are debating whether you should not close. You hold the position overnight. Day trader, you are allowed to hold the position overnight if your limit is not being too much. Because when you trade whichever broking house you deal with or whichever software you deal with, they normally want you to deposit some money there. You want to trade, whether the money, let's say you put 100 units money, they give you trade up to 2 times, you put or 3 times, or you put pledge against certain instrument, they will allow you to trade 2 times a day. So they will give you a limit that your system can allow to trade in. So it doesn't mean that. So if you day trade in and out many times, so if the system allow you, that means the moment you clear a position, they reinstate your limit to buy and all. So that means you can in and out multiple times without headache. But if their software is not so advanced or so flexible, so the timing for you to reset and to have limit again to trade, sometimes maybe a few hours later or not by the minutes, maybe by hours, and then you are at a disadvantage. And some company maybe they don't allow you to within the same day. They only allow next day. Then they reset the credit limit. Then you are in trouble. Right? So all this ability, whether you can or not, you have to inquire with the company how fast they reset your limit after you clear your position on the same day or same hour. Right? So there are many factors to consider when you want to hold an overnight position. And each market, whether it's a stock, a forex or future, have different factors to consider. Now, when you trade whether Singapore market or Malaysia market or Hong Kong market or what, you're watching that market, you are awake, you are having trading in the same time zone. Take for example, if you are trading the Europe market now, their time zone start around Singapore 5 o'clock time and then start until maybe 10 o'clock or 10, something like that. That is a European market. Then if you trade the US market, Singapore time zone is about 9 or 9:15. You start able to trade until midnight or 2 o'clock or sometimes 3 o'clock, depends. But now no more time, daylight saving, so about 2, 3 o'clock the market stop. But that is for equity. But if you are trading currency or futures, it's round the clock. Whichever time zone you select, you can hold your position round the clock. You don't need to close. Especially for futures or those currency, the time zone is like round the clock. So it's all depending on your position. So you don't need to close. This one concern mainly forex and stock. Future, of course, if you want to sleep, then you better define the time zone you want to trade, so that you still can aware and watch your position, then you go to sleep. Because if you carry your position overnight or over hours or what, then you are exposed during the period. If there is some bad news, like 911, sudden bombing or certain thing trigger. Take for example, you happen to buy Boeing counter, Boeing share, and then there's this explosion, in crash, whether in Indonesia or now in this Africa there. Then suddenly, because of the bad news, all the factors related to the airline, the price drop. Or maybe the contractor, the engineer, or the share itself plunge very much. So if you didn't have a limit or you are not watching the position, then you may be hit quite badly, or you don't have a stop loss position. You carry overnight and you don't stop loss, then you can hit badly. So that's why the different factors to consider overnight is that what type of risk or risk management you have. Effectively means how your software allow you to stop your position, whether you already pay for your money or what, pay for the share or not, that you can allow to, let's say you drop 10% or drop 8%, that is your threshold of pain. The position will be automatically cut, that means the share will be sold off for you automatically. So that is a risk management. Then the capital cost of holding the position. Now, many a time for the traders, they all trade on margin. That means, let's say they have 100 units of money, sometimes they trade up to 300 times the 100 units of money, or maybe 500 times the unit of money. That means there is a capital cost of holding to it. So if you are using margin, then your exposure is multiplied the number of times. So let's say you are trading 3 times or 5 times the margin. That means effectively you only have 100 units of money, but you trade up to 5 times, 500 units of money. So if your stop loss is not well controlled, sometimes your whole capital can be wiped out. Because you trade 5 times of your money, so you lose 20% of the money. That means effectively is your cost already wiped out. That is called leverage. The changes in leverage. And strategic reason for holding the position overnight. Sometimes the traders, they also search the internet, they also got their connection. They say, there seems to be some good news coming up within the next day or within a week. So even they are trading, they decided to hold the position overnight or more than 1 day time frame, so that when the good news come up again or what, the next day, then people react to the particular equity or stock or what, then there will be some chase up the price, then you can so-called sell out and make so-called better with profit. That is for profit point of view. That's why they call it strategic reason. Or sometimes you're taking a short position. or you bought option. So you buy an option, you hope that maybe the British Airways or the Boeing Airways, the price will drop some more. You buy an option, so you continue your position for next few days until you drop to a level that you like to take the profit, then you get out. So sometimes that is for strategic reason, because you foresee that this bad news will affect more and more airport will restrict the flying of the Boeing jet of that particular model in their country. So a small country decided to stop the takeoff and landing of the aircraft model, so it will be a bad reputation for the Boeing jet. So that will affect their business. So the share price will become plunging again. So if you are betting the share price will continue plunging, so you buy option, then you hope that it go down up to the point that you desire, then you take profit. So that is what I call strategic reason. Traders, they got different strategic reason to handle. So effectively, you analyze your overall strategy. I mean, what you are hoping to achieve before you decide whether you want to hold or you want to clear your position. This one, especially for day trader, you have to be very clear-minded that this is what I want to do, this is what I do. You already define your trading plan before you enter the position. Otherwise, after you enter, then you half-heartedly don't want to do this, I think like that, wow. Then it will be a very torturing for you, because you don't have set certain goals for you. If at this point I will take profit, at this point I will lose money. It means you are mentally, you already have defined a trading plan whereby I want to make 5 cents, but I'm only prepared to lose 3 cents, not more than 3 cents, something like that, for each position you take. So then you will be more comfortable and you set it in the system. Then you can play the game. So among some of the reasons that you want to hold a day trading overnight is that by rule, or the rule of the thumb is that one don't hold the trade overnight. Therefore, if holding a trade overnight, consider reason for doing it. If the reason is not sound, then close the position before the market closes. This is easier said than done if you don't have a trading plan. For all you know, because we are very what I call fickle-minded. Our heart and our mind don't work with the hand. Sometimes you want to do this, but your hand says, okay, hold on first, I go toilet or I do something else, or I go lunch first, come back then and decide. So that is what is the unfortunate thing. So our heart, our mind and our hands all must work in the same direction that you want. Typically, traders want to hold a trade overnight, either to, of course, if you hold a position overnight, but you are already making profit, that means your position is a profitable position, then, of course, that is good and fine. And the question of if they are hoping a losing trade will be reduced or turn the profit the next day. But if your trade you are holding is a losing position, then you hope that the price will move in your favor the next day. That's why you hold the position overnight. This side is very dangerous, because trading cannot just based on hope. You have to have some defined plan. You place on hope, later on become hopeless case, then will be very, very challenging. Because sometimes if your position is bad, if your loss position up to 5% loss, you are very comfortable to cut the position, fine. But if up to 5% you didn't cut, you carry over the next day, then the position gets so worse, maybe become 50% loss. The moment open next day, drop up to 50%. That time, then you much hesitate to cut now. Then you will find that you already big hole. And then if you are on margin situation, then the software company or the broking house will call you up, hey, Mr. Tan, your position is very bad, can you top up your margin? Otherwise, you force your position out and all these things. Because sometimes if you are leveraging, once you drop too much, your margin position already hit already, then they will sometimes force your position out. That even you don't want to sell, they force to sell you. That's why you heard about now the Rumon case, that the So Jin Wen, the case is coming up, all these things. You will hear a lot of these sort of stories of why the broking house impose margin call on this customer and at what level they will call. So when you sign up a contract with the broking house for margin trading or leveraging, they normally spell out the term. At what point 140% or 150% they will have margin call. If you drop to 130%, automatically they will force your position out. They don't even call you. They say, if you hit the position at that margin position, they will cut you off. Even the share that you bought already pay for, but under margin, but you drop for that particular share, if you drop below that margin position, the company has a right to force your position out. So those are spelled out in the contract. When you do margin trading, they spell out in the contract. So that's why when you hold overnight position for margin, even if you pay for the share, that means you are not in open position, you already close the but you are holding the share under margin arrangement, the company has a right to force your position out. So these are some of the considerations you have to consider if you happen to be buying or trading share using margin. So successful traders have clearly defined boundaries about when they trade and when they will take profit and losses. Often these boundaries include the use of stop loss order, trailing stop, and profit target. Now, stop loss order is basically, let's say you buy a share at $1, let's say you prepare to lose 5 cents only. That means at 95 cents is the stop loss point that you want to get out of the position. So that is a stop loss order. Trailing stop is quite often when you buy a share at $1, but your share is moving up, let's say to $1.05, $1.06. That means you are making money, but you don't want to lose the profit that you are making. So you put a trailing stop. So that means now it's at 106. So you set a stop loss or trailing stop if your system support that your trading position. So you said 104, I want to take profit, I want to get out of the position. So this is called the trailing stop. That means you trail your share price. The moment you drop below your desired profit, you will get out the trailing stop. Next time is profit target. So example, you buy $1, whether same day or next few days, you aim to make 5 cents. So the moment on the same day or overnight, you hit your 5 cent target, you will get out. They call profit target. That means the software allows you to set by the price. The moment you buy, you already set, okay, stop down there to get out. So you drop 98 cents, I will get out also. So you set profit target and stop loss target to set in the system. But for the more sophisticated people, sometimes they don't want to put the stop loss position or profit target inside, because the other traders, the smart ones or some market makers, they can see if you set in the system, I mean effectively you put your sell trade down there. So some of these smart people, they got some computer software, they can check. Many people are setting the stop at this level, selling at that level. That means these are the cluster of prices that a lot of people will want to take profit or stop loss. So they sometimes purposely push the price like jerk it a bit to hit your stop loss position or hit your expensive stop loss position. They purposely drop suddenly, but then later the price all the way out. So because of some of the smart so-called people who design certain trading software, they can see if you set stop loss position in particular software, but other people can see your position cut down there, they can see. So because of that, they design another software to identify where are the stop position. So they purposely sell quite a lot of few quantity to let it hit the position. But immediately after that, the share price run out again. So some of them they program it like that. So because of that, some of the traders they prefer not to set in the system but use manually monitor to click the position, or they set another system to alert them should the price hit. Then they will send a signal to their trading software to alert to so-called trigger the trade. So now because of software, there are a lot of mechanisms that you can do. So that is why sometimes you find that your eyes blinker a little. You see the share price hit as well. How come the trade done already, and then you see the price like no change because some of them they use what I call the robot trading system. They can move the prices very fast. Before it's a microsecond before your eyes can see. Okay.
If a lot of people stop loss, let's say at $1, who comes first?
Okay. Whoever, if you already in your price is already the queue, they got time priority
Or not as which computer is faster? That means they queue stop loss. If
you didn't put in the system, then it's your computer speed
It is a queue already. Stop
Yeah,
loss is the queue.
already in the queue.
So you put early. You will be right in front of queue
Correct. That's why some people trading they already they have like they design some software that some of the trading system allow That means the moment you buy the share, automatically they set the sell price or stop loss price auto set for you already. Straight away the bracket down there. That means the moment you hit your purchase, they already set the position for you. Most of the newer so-called broking house software allow that. Especially in the US market but in Singapore market, if the broking house never pay for that particular facility, then the broker cannot support you with that facility.
Okay. Then earlier you said somebody can just sell until your stop loss, and then you buy back.
Yeah.
But that fella cannot make money. If you sell at $1, then buy back at 110, how to make money?
You see, people, traders, especially day traders, the moment they say they are hit a position, they will try to so-called, because they see what I call the short-term traders or the day, they are all trading on trend. That means whether the share prices are going down trend or moving up trend. So if they have analyzed the general trend of the market is trending up, so they are confident that they should go long and run. But how come suddenly the price move back? So they know that if I out, never mind temporary, but if once the defined trend re-establish, they will go back again already. So hit already, but after they come, how come you continue at the higher than my previous buy price? So people will jump in again to buy and want to ride the trend again.
But the fellow push down the price you lose money
No,
already.
he already designed it. They see what is the amount of money he spend, they will calculate the amount of money to spend to trigger their buy, and then after that,
Turn back
and then I write the trend they create the trend that the trend changes again. So the other people see the trend, they will go in and join in the trend. So when you join in, they really unloading to back to you.
So they lose some and then they
push up. They push it up so you all will join the new trend, then you make it. So all the day traders are all basically trend traders. That means they identify the short-term trend, how long, the longer-term trend, how much. So they write the trend. More explanation. As for losing day trades, they should not be held overnight. Generally speaking, most gurus will tell you when you have a lost position for day trader, you should close it. You should not hope against hope, go and carry your position overnight. No, that things will change to your favor. Because day trader, your basic plan is that you should have a proper risk management protocol. That means you define if you lose how many percent or how many cent per trade, I move up. Then in the same day, you watch for new opportunities or look for another counter or another share which is in your favor, the trading setup pattern to your favor, then you should consider the other one. That means you don't keep on watching one horse only. That means the day trader normally they have monitor, let's say some 5, some 10 counters at the same time. They don't just look at one. They have what I call keep in the radar screen more than one. So they will see which so-called counter is the most beneficial in terms of risk over reward ratio. They calculated based on risk reward ratio. Normally they take about 2 times or 3 times risk reward ratio, then they will enter a position. They don't just anyhow go and take a position if the risk reward ratio is not to their favor. Because why you do that? Because if you don't have a risk reward ratio of let's say few times, it means if every time you're lost, then but when you don't make more than enough to cover the losses, then at the end of the day you are in the net loss position. So that's why they always want to make sure your risk reward ratio is more than a certain percentage, then you take a position. Because that means I enter this position, if I lose, I prepare to lose let's say 2 cents or 2%. But if I want to make 5%. So that means the risk of profit over the loss is 2.5 times. So that means worth to take the position. I mean, that's on theory lah. Whether in practice the market move in your favor or not move in your favor, then you have to monitor lah. And holding the day trade after hours can be a gamble. Okay, this after hours is typically in the future market and in the US market they have it after hours. That means the normal hours, let's say in the US market, from 9 o'clock until 2 o'clock, our Singapore time 2 o'clock, 9 o'clock, evening to 2 o'clock. That's the official hour. But before the hour and after the official hour, they have what I call the after hour trade. So after hours, that means you still can trade. After hours they still you can still trade, but after hours sometimes it's only 1 hour or 2 hours for you to clear your position. They allow you to clear your position after hours. Right? But in our market, only the future market and indices they got this after hour trade, but the stocks no after hour trade.
Stop 5 minutes.
That is pre-open and pre-close. So holding a day trade after hours can be a gamble because once the market closes, new risks are introduced. There's risk but vary by market, and with some presenting more risk than the other. The risk can be in terms of I don't know whether some of you have a habit of reading about some of those stock trading books. They say why some people lose. You know, last time Singapore famous history is that Nick Leeson he blow the UK, the Baring case, blow the oldest bank in UK, you know, because he do a lot of carryover position and then he play tricks in his company. He wear more than one hat. He also the risk manager, he also the trader, he also the settler. So he purposely cover all his loose state, push to one account, and then making trade when he report to the headquarters in UK that he making money. So that means he have many different accounts. Lost the account, he don't report to the management. But make money one account make. So if that's why in the bank or in the trading room, they purposely separate. If you are appointed or you are employed as a trader, you only responsibility as a trader. Then the risk manager will manage your exposure each time, how much money you expose. And then the settlement officer or settlement people will make sure the settlement contract is dispatched out to the client accordingly to tell them the actual position, how much loss or how much money they are making. So they have to separate these rules or define these rules. Then they cannot mix up. But if you mix up, that means a lot of chances of cheating can happen. So last time Nick Mason bring down the bank because he's cheating. He report only the good position, bad position, he hide into another account. And also, when he play the time, he plays certain so-called futures or these things. Let's say he play Nikkei 225 future or this thing. So the other companies or banks will also play this share. They can identify who is their counterparty one. So if people know that you are the one who are trying to so-called play the market to a certain way, other people who are familiar with your trading style, they can gang up directly, officially or unofficially to so-called make you lose a lot of money. They can corner you, that means they corner you. Something like push your price to a certain direction, then you frighten already, then gap, because of lack of liquidity. Whereas you look at, let's say in Singapore market, you look at the banks, the bank counter, Singtel share, all these shares, or most of the index side, you seldom see gap or very little chance of see gap. There's a price gap between the opening price and yesterday's closing price. Less of this gap because the liquidity is good. So that means there are a lot of buyer and seller. So if there's slight difference with price, the buyer and seller will match quite fast. Whereas if the participants is less, so each one watch there are not many other players to fill up the gap. So as a result, it causes a gap between the opening and closing price. So the risk of single gap compound if there's overnight news that the stock, because of some announcement, they got new project or new product, so the price shoot up quite different. A gap could also work in the trader's favor, creating a much larger gain than expected. Of course, if there's a gap and the gap will work to your favor, you hold one night, then it's your bonus, become your bonus because somebody want to buy at such a high gap, maybe instead of you make only 5%, suddenly make shoot up to 15%. That's your luck because a sudden gap up. You look at especially creative technology when they have some announcement or some news, often the gap up quite wide because there is not very much liquidity. Okay, factors to consider in the forex market. That's why we talked about the stock market. Forex market trade 24 hours. Forex market means you trade currency. That means you buy dollar, you sell pound, or you buy yen, Seng, and all these. These are forex. Trading is a seamless between the Sunday night when currency market open and the Friday open. Price gap during the week can be occur over weekend. For forex market, they only close they close 24 hours only on Friday closing and then the week can following weekend. So there is no trading. When there is no trading, then you can have gap. Price gap we observe when major economic data is released. So recommended days is close out trade needs to be backed by schedule high impact economy and over. This happen, example, when there's a FOMC, Federal Open Market Committee meeting, US market, they every 2 months or what they hold a meeting to set the benchmark, the interest rate where of the FOMC, they charge the bank. That means the committee, the central bank will charge the the commercial bank by what interest rate we decide. So during those periods, if the forex market will be very volatile, so if you hold position during that, just before the meeting, you didn't clear a position, then suddenly because there's some announcement of the foreign exchange, the interest rate, so the price of the forex will fluctuate a lot. So it can be hit quite badly. So at 5 p.m. Eastern time, your broker will either credit or debit you with interest based on the currency you are holding at that time. So when you are trading forex, you will gain interest at the end of the trading day at 5 p.m. Eastern time by virtue of your position. This is called rollover. You can enjoy rollover interest rate. Typically, this is a tiny amount, a few cents to a few dollars if you're holding a standard lot or smaller position. Holding big position after hours, after fair, may result in a tiny rise or fall in activity. So, if you are a day trader in the forex market and you are having small position, then the interest you gain or loss as a result of holding a position is not very going to impact you a lot. But most currency pairs have much higher volume and more movement when European and US market are open. Now, example, now the hours, European market and US market are also open. So the volume of the currency will be more. So volume and volatility typically drop off when the market are closed. So day traders are better off trading during active time and closing position before quiet time or by currency pair. That said, it's always a major global market open for business somewhere on the globe, allow for seamless across. So those of you who are in the forex market, or if you want to look at the Bloomberg News or the CNBC News or Channel News, Asia News, all this you can see. Normally during when the time zone cut over, take for example Singapore, about 5 o'clock when the European market open, that means the Singapore market and the European market time zone crossover. There will be traders who carry the position from one time zone to another time zone, or they try to close another position. So during this new opening of 2 time zone crossover, normally the market are very active, and most of the traders would like to participate during this area. Similarly, when about 8 or 9 o'clock, when the US market open and European market are still open, there's another crossover time. So the market will be very volatile. So you notice during this period when the news reader, you look at CNBC or CNN or what if you look at the announcement, they're all rushing around and making announcements. At that time the prices are very volatile, especially for currency market. So quiet time in the currency market, and also for the traders who participate in the currency market, sometimes the whole day, whether they make or lose, is during that time zone of 1 hour or so. After the time zone, most of them they don't trade because everybody more or less know about what proper direction. During the so-called crossover time, it's similar to those of you who go fishing. You know why the fishermen or those fishing people go fishing on the sea? They always look for the tide. So when the tide come in or the tide go down, because the water moving, right? So the fish also like gong gong. So you do fishing, the chances of getting a bite or the bait is there. Because a lot of and the fish will come out to look for food during the tide changes. So the movement and a lot of uncertainty at the time, that is the time like a fisherman you can catch fish. Similarly, when you play the stock market, the same. So when during the crossover time, there will be a lot of so-called balancing of the news affecting this market and that market. So there's certain uncertainty and movement. So a lot of those small time traders, they will also use this period hopefully to make something of it. A small gap, they can make something. So normally most of the day trader will be active during the trade lower time zone. There's a period that is chances to able to make something. But once the market stabilizes, you find that quite stable, then very difficult to trade. Normally they can trade is when the market is very volatile at the time. So in case of future market also is a 24-hour day, right? Hybrid of the stock market and forex market. Future is like a hybrid, it's like a mix of stock and forex market. Future markets are mainly indices, more of the index future or currency future. It means you are reading the market 1 month down or 2 months down or 3 months down. So let's say gold future, they anticipate in 3 months time the gold prices should be this way or that way. So they are trading future like that. So oil market like WTI, Western Texas Index, very popularly traded in US. So those are future market. By and large, future markets are traded by the institution or institution trader or the professional people are playing. Because future market are normally traded based on leverage. Maybe you put in 100 units of money, you can trade up to 4 times or 3 times or how many times. So these are all professional players are in that. And they are traded 24 hours per day. But capital and risk are affected by holding overnight. So futures, you will hold a position, sometimes it's very expensive. So unless you can have a lot of capital to put in as a deposit, then you can hold bigger position. But if you are a smaller time trader, then you may not have able to hold many positions overnight. Day trading margin, how much of the broker requires is the account today trade a future contract. It's typically significantly less what is required in holding overnight. Check with your broker what is your initial margin, right? And all these things. Right? You may require to put up to 5,000 for one contract you hold overnight. So to hold one position, if you trade a small contract, a day contract, sometimes your margin is only you put in $500. But if you put a contract and hold it overnight, sometimes you for the same size of contract you have to put $5,000 so-called margin. So the broker also want to protect themselves. They don't want to expose themselves too much. So you can 10 times, 5,000 versus 500. You have to put 10 times the amount to secure one contract. Outside of normal trading hour, volume typically declines significantly. This is part of expected because once it's off trading hour, the off market, the bid and offer become very widespread. So very difficult to trade. So not many people want to trade. But there are fewer participants means there's less movement, and the trader can't make much from that if you don't have much movement. While most future contracts trade 24 hours a day, there may be price gap if economic data is released or significantly come about. This is expected when there is an announcement of this trade war between China and US. Someone say, oh, they're going to meet and they're going to reduce the number of so-called products that will be considered under this trade war. So all this will affect the prices again. Those of you who trade future, you know, you have to maintain maintenance margin at the end of the day. So you trade future, besides the initial margin and all these things, at any time you have to maintain a maintenance margin so that your position will not be forced out. If you don't have money enough for the margin, they will ask you to close the position. So because of that, you have to maintain certain amount of capital to maintain the margin. So all these are spelled in the contract one. So if you want to so-called hold more position, then you have to have more money. If you don't have enough capital, then you have to close some of the position. That's why I say, for some of the position, you put $500 on the day trade, but overnight position you have to put up 5,000, 10 times the amount. So, factors to consider. Forex is a seamless 24-hour market with the exception of deficit interest. So, Forex is a 24-hour market with the exception of credit in debited or credited interest during the position at 5 p.m. Therefore, holding an overnight position in the market isn't a huge deal, though volume of it are the main consideration for the European and US session. So now they compare Forex versus stock. Stock carries significant risk when holding overnight. Not only is the risk reduced and interest charged on leverage, but the trader is also less exposed to potential large price gap, which can result in a way large losses or profit than expected. Stocks, because it's not traded 24 hours. So between the time the market close and the time the market open next day, sometimes the gap can be quite significant. So as a result, the gain or the losses can be very huge. So when you consider to hold stocks for day traders overnight, this is a very significant point. More capital is required when holding future position overnight. That's what I already discussed. Future position compared to day trade, you may have to move up 5-10 times the maintenance period margin. Future trade around the clock, but volume is typically much lower outside normal business hours. So day trade should be left as day trade. The summary or the conclusion is day trade should be left as day trade. Unless the day trade was originally planned to be held overnight, it should be closed during active market hours, right? Normal market hours. This helps to avoid the common problem of holding to a losing trade. Because the moment you didn't plan for holding a position overnight, you go and convert a day position to a overnight position, you are exposing to a good chance of a losing trade. For longer, is a hope that you will return to profitability or gambling whether a market will jump or dump overnight. For those who are traders, you know, normally once you miss the golden opportunity for day trade to make a profit, then it's better that you get out of position with some loss or a little loss than you try to hope that you will able to make a gain by holding it overnight. So whether day trading or holding overnight, be aware of high impact news event which could render a stop loss. Because if the news happen to be affecting interest rate or affecting certain political situations, sometimes you may, because of lack of liquidity, your stock position down there, but because nobody want to so-called buy from you at the stock position, so as a result, the price start next day is much lower than the stock position. So effectively, you are not stock up, you have to pay for the big gap. Let's say you buy $1, you put a stop loss at 95 cents, but because you didn't close the position, next day the market open at 90 cents or 85 cents. So as a result, the gap between your buying and the selling out become 15-cent gap, right, or 10-cent gap. So that's why, because you close overnight, you didn't able to clear your position because overnight no liquidity. So as a result, your loss become multiplied more. But of course, on the contrary, if there's some good news, maybe you buy $1 because of the good news, you may shoot up to $1.10 or $1.15, then you can make huge gain. So this is a big gamble. Nobody will able to help you when that happens. Right?
Why sometimes there's the bank borrow and then transfer borrowing transfer money borrowing.
Oh, okay.
Extra interest.
Banks, when you, let's say those who borrow money from the bank for if you buy currency or what during the weekend or the off hours, when the bank cannot get a rate from the, not you go say bank, you go money changer. During the official trading hour there, money changer, they look at the Reuters screen they can quote you all currencies and what all this and what the prices they can quote to you. But after office hour, you go to money changer, you find how come the exchange rate is not so you see the buying rate and the selling rate, the quotation is quite wide. Become wider, even the money changer buy. Because if they quote to you at that close gap, but they want to buy from somebody, when they quote to you, that means they may be able to buy back from somebody to sell to you. They cannot get at that type of price, so how they can sell to you? So that's why they have to protect themselves. They put higher and lower than the daytime rate, so that in case I buy from you, later on you cover back my stock, I am able to cover my position. If not, they may stand to lose if they sell too much to you. So that's why when you want to change money also, or you want to go to bank or go to money changer change money, you have to go during the official the business hour. Then they give you good rate, because they buy from you or they sell to you, they can buy back from some other money changer at around the same price or same rate. They don't know, because money changer make on very little decimal point, third decimal point or what. So that is why you have to understand why sometimes you get better rates. So we come to the end of our discussion. I hope I have shared with you some interesting stories that you understand sometimes the mechanism behind certain market forces. But all this day trading, as I mentioned earlier, is a very high risk game. It's not a everybody game. Really, most of the participants of the future currency, all these things, the professional people, whether they are doing on their own trade or engaged by the banks or by booking houses or what, normally they prefer those in between the 20s and 30 years old. They want the younger people, more gung-ho, and then they are much faster in their reaction. They want those people. As you grow older, your reaction time will be slower, because for them, they play in high volume. They look at the decimal place, is the third decimal place or what. They look at third decimal place. They play currency or future, they look at third decimal place. But they trade for the banks or what, they trade in big quantity, big money, millions and millions they play. So last time I got one relative, they used to trade for the German bank. Every day he shout, and at the end of the day, those days they still using they using phone also, connect to the open archive system. They shout until no voice, because they have to compete with the traders, the central trader trade. So they keep on shouting to get attention, so they can get their quote and get the deal. Or they play third decimal place. And sometimes even the professional, let's say they go they report their profit and loss every quarter. Let's say the first quarter between January to end of March. Okay, they may make some money during this quarter. And Second quarter, they also managed to make money. That means from April, May, June, they make money. Third quarter, sometimes because of some market sensitive news, they didn't react properly. Sometimes they can lose. First quarter make money, second one. The third quarter they can blow, they can lose a lot of money. They can lose a lot of money for that quarter. That means even for professional, if they don't control their overnight position and their stop loss properly, sometimes over 1 or 2 trades, they can blow out. That means they can lose a lot of money for the banks they are looking for. So that means even their so-called pro or what, their credit control people will have to manage them properly. So they will make sure they don't anyhow carry position overnight. Like for the big bank, if they carry position, they will normally pass the position over to their corresponding body in the different time zone. You know, if they trade here, they have their offices in London or New York or what, they will pass their position over their other time zone to trade or to close or what, so that their position can be managed. So they cannot say because they take a position, they are in a certain position, but leave it alone, wait for next day. Especially for futures and currency, it's 24-hour market. So they normally have to transfer their position to their company's colleague in another time zone to continue trading. And so after that, they finish the time zone, they transfer back to Singapore time zone for them, or Eastern time zone, so that they can continue to trade. So that's why these instruments are mainly for the professional people. Their customer may be like the central bank. Sometimes their customer can be the government or the central bank. So they buy and sell for the government or for the bank, so the other bank. So they trade with the other bank. So those products are really professional products, and really they hire professional people to. They come with a lot of sophisticated computers and instruments to help them. Of course, these people also sometimes they play tricks. That's why they are being prosecuted by some of the government. They are supposed to set official rate between for the other customer to trade, but some of them they use WhatsApp, use those social media, use a phone. Secretly, they pack up among the few banks supposed to set the rate for the customer. They pack up to adjust the rates somehow. So as a result, the customer buy high, every time buy higher rate. But because of they purposely set higher so that they get the good rate sell to them, then later among them they settle the position close to them. So this was not so easily uncovered. Only lately, in London and all these things, all those central bank, those banks appointed as a so-called party to set the official rate for them to discuss, to set the official interest rate for the government, or they were caught by the government. They are playing tricks against the government. They pack up among the various banks. They say, I'm the government, I want to buy US dollar. So I ask Bank A, Bank B, Bank C to quote me the rate. I want to buy US dollar, how many millions of US dollar. So they know the government coming in to buy. So they all pack up again. Hey, how much you quote? How much you quote? So that everybody quote quite close to the rate. So that when the government buy from them, the government has to pay at that rate. But actually, the market rate is not so high. It's lower one. So the government end up paying low. But later on, among them, they help each other out at a lower cost, so they make a bigger gap. So even government can lose money. It's like if you are not careful, the bankers, they pack up among themselves, they quote to the bank, to the government can lose money. Last time, previously I heard during Mahathir time, Mahathir tried to be smart. He want to play the currency market. So he engage somebody to trade the ringgit and all these things. So that's why during the time he always very unhappy with George Soros because George Soros, their team last time whacked the ringgit. Malaysian central bank lost a lot of money on the ringgit. So that's why even government, you are not sharp and you are not, your team of people are not effective. The government can lose money. So now, until now, the ringgit is still a controlled currency. It's not freely traded. Ringgit is not freely traded now. Still as a controlled currency in the foreign market. You go and look at the chart. They got currency pair like Seng, US, this yen, dollar yen, dollar baht, all these. You can look at ringgit, it's still under control.
But why Malaysia so big and Singapore is so small? Why they must control that currency?
Because they thought they are smart enough and they are big player. The currency, my country currency, I should able to dictate the exchange rate. Because I'm the biggest player, I sell ringgit or buy ringgit, I'm the biggest player.
Yeah.
They didn't know that market is so wide. The whole world is the player. They can so-called control. Can manipulate the currency. That's why, as a result, a lot of people trade to Singapore market. Indirectly trade the ringgit through Singapore market. So as a result, they lost a lot of money. They fed up with Singapore. They say, you're Singapore because you have an offshore market. You create a havoc for our currency market. So if your country are not good traders, your country can lose a lot of money to foreign exchange trading.
What's the advantage if they open or don't open?
When it's open, any Tom, Dick and Harry can buy and sell your currency.
Okay.
Right? But if it's a closed situation, that means there are not many traders in the market for your currency. So become the price between selling and buying is very narrow. There's no advantage for you to trade the currency. Take for example, I went to Myanmar and I changed the local currency. I changed US, you change back to your US about the same. No, because there's no international market for the currency. So there's no much movement, will be about the same. So similar, Malaysia, if it's a control currency, you go in and the price come up about the same price.
Singapore also is a small country. They then open, then still no movement also.
Singapore currency, the central government also controlling the band, how much they can fluctuate versus the US dollar.
Always 1.36.
You think
So-
they have the power to control?
No, they have to control because we have a lot of reserve. So we have to, when there are too much people shorting your currency, you have to be able to buy. You don't want to buy, then your fluctuation. Because that will affect all the businessmen. Before you are a businessman, you are importing aeroplane parts, you are importing train or ship. So you quote the quotation at what price, or US dollar or what. Then you use so much Singapore dollar to buy the. But if you are planning to import so much US dollar worth of goods, but you didn't hedge your currency exposure, then suddenly people confirm the order with you. Wow! Then you find that, wow, I'm supposed to make so much in your quotation, but as a result, the Singapore dollar has weakened by so much. So as a result, your profit become less or become zero profit.
More. Singapore dollar weaken, you make more.
So depending what position you're holding. That's why if you are a country like Mexico.
US dollar.
No, you look at Mexico. In Mexico, Brazil, and all the Latin American countries, because the inflation is by the hundreds of percent per day. So all that quotation is valid only for a few minutes or less than few hours only. Not like in Singapore, you quotation valid for 30 days. because your currency is stable, you can maintain the validity. There, by hours only. So sometimes after you get the contract, you didn't secure your currency accordingly, you lose money because your cost of fund is expensive. You cannot make money from that. So in international trading country like Singapore, depend a lot of world trade one. We have to make sure our currency is very so-called easy to manage. You don't manage properly, whatever the businessman make money, you lose on the exchange rate.
So what happened to Venezuela?
Huh?
What happened to Venezuela?
Venezuela.
Venezuela.
Same. All the Latin American country and all these things, their inflation is very high because they are some of them are oil producing country, and yet because their foreign exchange is weak, so they cannot manage position. So many a time they lost a lot of money unnecessarily, and people who do trade with them, or this country who are weak in the foreign exchange, many a time they have to buy insurance. That means before they enter in the contract, they have to buy some type of insurance with those countries with currency is very strong to protect them, so that they say, I buy, that means based on current exchange rate, okay, I buy forward with you at this exchange rate, the US dollar, using my currency. So should I be successful in the contract, I'm protected. That means the exchange rate, I don't lose money. So the effective profit I supposed to make, we're able to make. So this type of, you have to buy insurance with a bank or with another bigger country to help you. Last time I was doing work for some of the Japanese company, we noticed that a lot of Indonesian company, when they want to buy things for us, they always open LC with Philippine bank or credit to a Philippine bank, because the Philippine bank, which is normally American bank down there, they will help them to open LC to us in Singapore, and they make money from the difference. A lot of LC come from Philippine side, instead of direct from US, they come from Philippines. A lot of American bank all through there. All the bank we seldom familiar one, all come from there. But the buyer is from Indonesia. All Indonesian bank, Indonesian customer open LC through the Philippine bank.
Why are so far away?
Maybe they give them good terms. They give them good terms. So the example, you say Venezuela, all these things, maybe they will open the LC or the bank, all those things, from some American banks or whatever. Who is now
you trade with them in US dollar or renminbi?
US dollars.
Not trade renminbi.
Now our friend China, very soon they're trying to establish the yen, renminbi, as the recognized currency for settlement. They're trying to do that. That's why our one belt one rule, they give like interest-free payment like that to build the roads for them, build the railway station, build the power station. Okay, you settle payment back in renminbi currency, pledge again your coal mine price, or pledge again your gold mine price, or pledge, all using commodities to settle. You pay back in 20 years time or 30 years time with gold or with all the minerals.
So yeah, not money lah.
Not hard cash, all minerals. Pledge, the mineral price based on the renminbi price, not based on US dollar price.
Oh, so the loan is renminbi.
Yeah, that's why now US very very frightened already, because all these brother all supporting him because they are owing him so much money, but paying all those minerals. So they are not worried. They say, never mind, you don't have currency, you pay back in the mineral. Okay, any question?
This bank, now you can buy currency from them,
Okay.
but then you have a debit card, you can draw money.
Correct.
And so you don't have
Oh, they call it the multi-currency account.
multi-currency.
Ah.
So which one is better, from the money changer or from the
The banks, they give you a rate. I go for a bank. I always compare. I change money. I go Euro. I change Euro. I come back. So I got access. So I deposit into my multi-currency account. Then they charge me also a certain handling fee, so very little. I monitor for 6 months. I cannot get back the type of exchange rate that I get from the money changer.
So money changer is much better than
Money changer is very sensitive to the market prices. Whereas the bank rate, they always get also from money changer.
The bank money changer has a lower operating cost.
Money changer, they got, no, you are right in a way, but more important, they have high volume transaction.
High volume.
Where? Very high volume. Money changer also make on the third decimal point, third decimal point, money changer make by third decimal point.
Okay, we change 1,000, now the bank go by millions.
No, bank they go transaction on the electronic by the million only. On hard currency, the money changer got a better rate.
Oh, hard currency nobody go to the bank to change.
You know, for information, every day about 3 o'clock, 4 o'clock, a lot of money changer come to our bank there to exchange the hard currency.
Oh yeah?
Yeah, all the banks say the money changer will come there to exchange. They will ask them, okay, they say we got customer want to have how much US dollar, all these things. So they will bring a lot of US dollar. So the bank will buy the US dollar, give them Sing dollar. So the money changer every day they go to various bank to do the transaction. The bank themselves do not hold different currency overnight in the bank work. The bank will not hold.
The bank use electronic.
They don't have hard currency in the account at the end of the day. They all exchange back to Singapore dollar. Money changer will hold the foreign currency.
Risky
They don't want to have this type of risk. That's why the money changer are making money but carrying the risk. The money changer themselves are carrying the risk. The bank don't carry the risk. The bank will carry the Singapore currency, so they will not carry foreign currency.
So when I go overseas balance currency, I can just deposit to the multis.
Yeah, you can put there if their multi-currency account support your currency lah. By and large, I know they support yen, euro, US dollar, all the major currency lah. But Malaysian currency they don't support. Ringgit don't support lah. Peso I'm not sure whether they support. This rupiah I don't know whether they support. I can tell you even euro I come back 6 months I cannot get back the money changer rate. Still suluing.
Euro keep dropping. Is it?
Then got one stage the US dollar keep on dropping. Then the money changer say, hey, you don't buy and keep. You better sell. Don't keep hold any US dollar. He said let's get the drop to that level. The money changer also tell me don't hold. So for information, the bank don't hold any other currency. Electronically they hold but physical hard currency, all the banks don't hold. They all keep, end of the day they will ask the money changer to take over the position.
Then when I go to straight away I will convert back to the money changer.
Don't need if the money going up. The other
But your
Indonesia, the currency no more.
But what I wish to tell you is that if you are not in business, that means you don't use the currency often to pay things or buy things or overseas, then go traveling, just change about enough, finish. Don't balance a bit, change back. Don't hold the currency. Unless you are a businessman, you need that currency often. Then you are playing a different game. You don't hold the hard currency. You negotiate with the bank to get the rate. They call it forex forward rate. That means for the next 3 months, I need so much US dollar. Can you give me a rate? You can call bank A, bank B, bank C. You are doing business. Okay, what rate you give me? So where's the rate that you think is comfortable? Okay, I book at this rate. That means you block the US dollar versus Sing dollar at that rate. So within the 3 months, anytime you need to draw down US dollar, you will buy from the bank at that rate. All the businessmen will do like that. You buy forward rate. That's why now you have, that's why we're talking about forex trade. Why there's a requirement for forex trade? Because of these people, the businessmen, they will have to buy forex for their business. So the bank, they will get a rate. They will in turn have to buy back the forex on the forex exchange to cover their position. So that as a net result, should you draw down on that US dollar within the 3 months, they will not lose money. The bank will make money or lose money depending how well they manage the exchange. Okay, thank you.
I think foreign currency they charge 0.2% when you deposit.
0.2%.
Okay, thanks.
If you travel with the U3 credit card, U3 credit card, then the exchange rate is very good, better than money changer. You become a foreign currency credit card.
They negotiate some new rules for the ICS. The DBS bank and ICS.
Yeah.
Are you affected?
I lose my job.
So you all retire? All of you retire?
By the end of the year. Now I have two choice. I have three choices. I either retire